There are a lot of different kinds of costs that we're going to talk about when we start looking at manufacturing costs and costs within a management accounting system. The first costs we're going to talk about are prime costs and conversion costs. Prime costs are costs that it costs us for a thing. So a direct material cost. When we buy materials to make a finished item, it's the cost that we pay for those materials. Direct labor is also a prime cost. The hourly wage that we pay people who assemble our finished products is a prime cost. Conversion costs are the costs necessary to convert direct materials into a finished product. This makes direct labor both a prime cost and a conversion cost. Manufacturing overhead is a collection of costs that aren't direct materials or direct labor. What goes into manufacturing overhead is a variety of costs, such as our building rent, depreciation, supervisor salaries, and other things. We'll be spending a lot of time on what items go into these costs throughout the semester. So when we talk about these manufacturing costs, direct materials are the components that we use in production. Direct labor is the payroll cost of the employees who create those products. These are the assembly people on the manufacturing line. Manufacturing overhead is anything that doesn't fit in direct materials or direct labor. It goes into a broad pool that is known as manufacturing overhead. When we look at this chart, we see the physical flow in production. We purchase direct materials. We get them delivered to our factory. Then we have different kinds of direct labor use those materials and convert those items into finished goods. Once we have finished goods, we sell those goods. We add the costs of our direct materials, our direct labor, and our manufacturing overhead into the cost of what it costs to make an item. So once those three things are added up, then we know how much it costs to make what we are manufacturing. So we can determine how much we need to sell it for in order to make a profit. Product costs are costs that are consumed to create inventory. Direct material, direct labor, and manufacturing overhead are all product costs. These costs are part of our inventory on the balance sheet. When items are sold, they become cost of goods sold. A lot of this chapter is informational. This stuff becomes easier to process as we're actually doing it in homework examples. Period costs are costs of the period. These are expenses that are on the income statement. These are our selling expenses and general administrative expenses. What ends up as a period cost is any cost that we have that gets recorded on the income statement that is not part of the product. So if we have an office, any of those office staff costs, the office rental, the equipment depreciation, anything that is part of the office is a period cost. It was not necessary to create the product for sale. The factory building was necessary for us to create the product. So the factory building payment is a product cost. The office building is a period cost. We're going to do some examples in class where we figure out where costs go. That's one of the things that we're going to identify. We're going to break costs down between period costs, product costs, direct labor, direct materials, overhead. So we get our mindset into classifying all of these costs. This is an example of our cost flow. So as we saw, product costs end up in inventory. So they move from inventory on the balance sheet to cost of sales or cost of goods sold on the income statement. Period costs are those other expenses that don't end up in our inventory account. Product costs have to follow the matching principle. So product costs are only reported in the income statement when they can be matched to product revenue, which means that we don't record an item as a cost of goods sold unless we're also recording revenue from that item. So that's how we get the matching principle. We have multiple inventories when we have a manufacturing business. In Principles of Accounting 1, we dealt with merchandising. Merchandising companies have one type of inventory, merchandise inventory. In a manufacturing business, we have multiple types of inventory. First is our materials inventory. These are all of our direct materials that haven't been started in the manufacturing process yet. So this is every individual item that we buy to build whatever we're going to build. We keep that in the materials inventory until we start it into production. Our work in process inventory are things that we started to build but didn't finish when the month ended. So we're building a tractor and it's only partially completed when we need to run our month-end close. That becomes work in process inventory. It doesn't get moved to finished goods inventory until it is ready for sale. So then it becomes a finished product and it sits in our inventory until it is sold, when it becomes a cost of goods sold. This is an example of how things move through our accounting system. You can see that we have T accounts. We purchase direct materials. We get the direct materials and we record that as a debit in our materials inventory. We now have an asset. We have direct materials. When we use those direct materials in production, we transfer them to work in process. So we're going to credit the materials inventory account and debit the work in process inventory account. When we have direct labor, we're going to add that direct labor to the work in process inventory. When we record payroll for assembly line workers. When we record our manufacturing overhead for the cost of those items, we're going to record that in the work in process inventory. When goods are finished, we transfer them out of work in process inventory and transfer them to finished goods inventory. At that point, we are going to credit work in process inventory and debit finished goods inventory. When we sell a product, we will credit finished goods inventory and debit cost of goods sold. We will, of course, practice this in our classroom examples.